Ladies and gentlemen, welcome back to the channel. We are talking about forced share or forced loan recalls. I don't know which word you want to put on it, but it essentially means the same thing. The riskiest loans in the stock market. Those are going to be the first things that start to get pulled back coming this week. Now, you have seen a couple days come and go from this banking crisis that has started, but what you're not going to see under the scenes and what a lot of people don't want to tell you is that what causes recessions? When the banks stop lending, and that's ultimately the biggest problem here, and that is what is going to be happening and has already started to happen this week and beyond. Now, you also have the Fed meeting, and you also see that the Fed is now doing quantitative easing. Guys, it's not looking so good for the economy. Let's get into all of this information and how it can affect your money. If that sounds like something you want to be a part of, hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section, and let's get to it. So, AMC on Friday, down about 5%, up 1% in after hours. You're really fighting right now, guys. AMC is not going out without a fight here. Now, you have seen the Russell 2000 getting absolutely spanked on the ass cheeks over the last couple of days. And this is no surprise that AMC is the top asset in the Russell 2000. So there's not much you can really do there when you're down 2.5%. Almost systematically every single day. Not to mention the shareholder vote that took place on March 14th that doesn't look to be a very positive thing for the share price over the next couple of weeks. Now, we know we have the court litigation April 27th, and that's going to be a key to what we're going to get into next, and that is going to be the forced loan recall. I think that's a better word for it because it's not going to be specifically necessarily for AMC or for any one individual stock. It is to say that banks, when banking crises start to happen, where do they get money from? Well, banks, they don't keep your money in the banks. They invest in treasuries. They buy mortgage-backed securities. They lend money to personal loans and personal lines of credit. They buy stocks, right? They do a lot of different things with your money. They lend out money to stock investors, to hedge funds. Now, that's the key because out of all of those, what is the most liquid? What could hedge funds, or I should say banks, do to get the most amount of money back out? And in a pretty quick amount of time? Well, mortgage loans, I mean, it's pretty hard to sell mortgage-backed securities. It takes a while. It's not very fluid, right? If you guys ever watched The Big Short or margin calls, then, well, margin call more specifically, then you would see that it takes a while to sell these mortgage-backed securities. So that's not very liquid. Personal loans, you can't recall a personal loan whenever you want to from an individual. Auto loans, you can't do that as well. You could try to sell them for less than they're worth, but that don't make a whole lot of sense, right? Treasuries, at this point, if you're selling treasuries, you're taking a big-ass loss. So you could start to see when banks need money, there's not a whole lot of places they can start to go if it's not sitting in the bank. Banks are all about yield. They don't have that much money just sitting around on the books, typically. Now, the only thing that is really that fluid that you can recall almost instantly is going to be stock market loans. And due to this banking crisis, now, throughout 2022, throughout 2021, or any other time that you've really seen instability in the markets, it hasn't been due to banking crises, right? 2008's the last time we had a banking crisis, and that really was a banking crisis. And then what that led into was a recession because banks stopped lending. One of the first things they did in 2008 was pull out money from the markets. That hedge fund that's got a $100 million loan through JP Morgan or Wells Fargo, whatever, XYZ bank, right? Or fill in the numbers, doesn't even matter. They start to say, yeah, we're going to need that money back. But they usually give a 3 to 7 day notice before they actually do that, so the hedge funds can also come up with that money. So I do expect, as this banking crisis starts to unfold even more and you see more dominoes fall in this banking sector, right? Because there will be more casualties in all of this. Consider First Republic, well, not even technically First Republic, but Signature and SVB were the fastest bank failures in all of American history, or at least in 100 or 2 years. Right? I don't know of another bank that failed that quickly. Even Lehman or Washington Mutual, those other banks in 2008 that failed, it did not happen in a week period. We went from a week or two ago not knowing there was a problem in the banking sector, and now thinking all hell has broken loose. The Fed's going to go from raising rates right at a very drastic level to cutting them a couple times by the end of the year. That's a wild shift. And like other people have pointed out, specifically Liz Young from SoFi, the head of SoFi Invest, and many other people, but she's an easy name to remember, quite literally, and bring to mind. They're saying there's no good outcome from this next Fed meeting, and that is going to add even more uncertainty and pain for the banking sector, for the overall market. So I do fully expect, now this is not a guarantee, but based off of what we talked about in the last video and really just the events we have for this week, coupled with the banking crisis that we're seeing, I think you're going to start to see the riskiest loans in the markets, in the stock market, actually be recalled, because banks are going to need capital, and a lot of other assets are just point blank period not that liquid. It's hard to pull your money out without taking big losses. When you're loaning out to XYZ hedge fund, well, if you loaned $100 million, it doesn't matter what's going on, right? As long as there wasn't a preset agreement, which typically there is not with things like this, you would be able to get your whole $100 million back. Essentially, you wouldn't lose money. You might not make money on that loan or too much money on that loan, but you're not going to lose money. And that's going to be the ultimate goal right now with banks, is to really make sure they're all set. Now, I think this goes a little bit more for the second and third tier banks, but still, even the large guys like JP Morgan, Citi, Bank of America, Wells Fargo, they are also going to batten down the hatches, and this is ultimately what does lead to a recession. So with these forced loan recalls, I do think it is very possible to start seeing some very wild moves in AMC stock. Now, it would not surprise me on some of the red days that we're going to see this upcoming week, because by all means, I would be very surprised if there was not, to actually get AMC to rally, because AMC is a part of that subsector in the stock market that is one of the riskiest places to bet and trade in. And now that you have this court litigation on AMC coming April 27th, this is not a home run trade, and I think people will start to realize that in this upcoming week, and they're going to say, hey, AMC has fallen, we're going to start to take some of our profits from this trade, because ultimately, how much more is it going to fall? Even if this conversion does happen, you've likely already seen that drop. You've already seen the markets price that in. From my standpoint, now there's a lot more risk in the next couple of months shorting AMC with high cost to borrow rates when you've already secured essentially the profits, right, from already seeing this drop. It makes a lot of sense to get out of that short position before it potentially goes the other way on you. And I do think that is a big premise for why I think AMC could bounce this week, but also why you could see some degree of, if people want to call them margin calls or forced share recalls, or forced loan recalls, doesn't matter, whatever word you guys want to put on it. Fine by me. Now, at the same time, you're also seeing the Fed balance sheet actually just went up by the biggest clip that you have seen in a very long time, about $270 billion over the last 10 days. That means you are seeing quantitative easing. Again, quantitative tightening is where the Fed is essentially taking money out of the economy. They're taking that money from treasuries that are expiring on their balance sheet. They're taking money out of mortgage-backed securities, all of that. Well, You've been seeing that, and let's more so highlight this area. Can I? Why wouldn't it let me highlight this area? But this is from 2008, the whole crisis that began once quantitative easing really became a thing, and this is the Fed's balance sheet. Don't let me get too ahead of myself. This is the Fed's balance sheet. So that's the premise of quantitative easing or quantitative tightening. Hopefully you guys know some of this information already. This was the COVID crash, right? So they were unwinding their balance sheet over the last year. Now you've for the first time seen a massive spike in this Fed balance sheet. It's going to show that the Fed's probably going to announce quantitative easing. They're probably going to have some things to say that the markets are not going to like at all. And you are going to get a summary of economic projections coming this next week as well on Wednesday that could show the Fed might be planning to cut rates a lot sooner than what we expect. After all, once quantitative easing actually starts, not too long after you tend to get rate cuts. If you think about it, this was 2020. You seen the right? This went up. You got cuts, right? 2008, the balance sheet went up, you got cuts. Even during this period in 2013, 2014, 2015, you still got some small cuts in there. So I don't think this looks good heading into the Fed meeting, and I don't think it's going to make the markets any less volatile, and I don't think it is going to help keep AMC down when you're getting forced loan recalls, and this trade is not a home run trade. Over 5-6% of the legal short interest has come into AMC ever since this trade was even announced. So I think when you factor all of those things together and the attention that AMC currently has, it leads to that upside move. Now, if you take a look at AMC and these short interest numbers, not to mention, guys, cost to borrow rates, I don't know if I said that before, cost to borrow rates are going to be eating into those profits by a very large margin. Cost to borrow average at 335.21%, cost to borrow max at 358.94%, cost to borrow minimum at 7.6%. Interactive Brokers has the cost to borrow rate at 166.76%, about 6,000 shares that are currently available. The live short interest of free float sitting at about 24.25%. The live short interest, or the amount of shares currently sold short, sits at 125.1 million. So you are seeing a lot of not so good things for people that are short in AMC. High cost borrow rates, high short interest, right? Showing you high degree of volatility. Given what we're going to be seeing this week, I think it's very well likely that you will get some stability at the very least within AMC, but to also get some pretty big moves on some of these days would also not surprise me. So there is that. On a technical basis, this is not going to be a price prediction video, but I do easily expect AMC to break above $4.50 this week at the very minimum. Probably not go to new lows. I think you've already felt so much pain as of recently. You've priced in a lot of that bad news already, guys. So that is going to do it for this video. Thank you for watching. Hit the like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Most importantly, enjoy your weekends, enjoy the rest of your day, and I will see you in the next one.